Well, I don't know to what extent I'm in sync with the rest of the market's thinking process, and to a large extent, I don't really care because I don't think it's my job to parrot the consensus, but to tell you the things that I think are meaningful. And I really do think that the single most important factor in the market's movement over the past, say, 4 or 5 months has been the increase in the Fed balance sheet. I refer you to the article that's linked below. There's I do much more. I can get into more detail in an article than I can in a video. But essentially, as a result of the repo troubles, and those repo troubles are still somewhat poorly defined. I've heard so many theories, and because they're all kind of theories, I don't really want to get too far into them. They range anything from, repo market shutting out a bank or two, or one or two large banks changing the way they handle their repo, which is a technical measure. The long and the short of it is the Fed started backstopping the repo market. And what that basically did was the Fed started putting money in the system. Before that, the repo market was other banks financing other banks. Now you have this exogenous factor, the Fed, helping to finance that system. As a result, you've seen the Fed balance sheet spike higher by about 10% or so over the past few months. And guess what? The stock market's more or less followed in lockstep. And you could say, oh, there's several reasons why the market's going up. But basically, as far as I'm concerned, the market has two real catalysts because it's not really earnings. As we're getting into earnings season, they're okay. But the S&P 500 has far outpaced its anticipation of earnings. So I don't really attribute it to earnings. I come back to the balance sheet and fear of missing out, or FOMO. And those are two very powerful factors. One is psychological, FOMO. You don't want to be left on the sidelines and left behind. That's a human nature thing, and not always the best reason to be investing. Or there's the monetary aspect, which is a real thing. If money flows into the markets or into the economy, and this is in a second article, the follow-up to the first article, I went in a bit more about, the monetarism, which is semi-explains this. And basically, if you're putting more money into an economy, it's going to go somewhere. It tends to raise the price of something. There was always the thought that it was going to increase the price of normal goods and services, i.e. inflation. But that's not really what we've seen. What we've seen is that money tends to flow, that the inflation that we're seeing tends to be in the price of financial assets, which is why you're seeing both stock and bond markets, trading at very high levels. You're seeing very tight interest rate spreads on risky assets, risky debt. Basically, that money has found its way into the financial markets, and that's where we're seeing the inflation. And it's actually interesting that it's more or less unit for unit in the stock market. So what would I be looking for going forward? I think I alluded to the fact that Thursday afternoons, 4:30, the Fed releases its monetary aggregates, and including those are the size of its balance sheet. I would think if the Fed starts to plateau the size of its balance sheet or even outright shrink the size of its balance sheet, that's a worrisome sign. There tends to be a lag, though. For the most part, there's somewhere between 2 to 4 week lag. Monetary policy is not transmitted instantaneously. So the good thing here is if you start to see a pattern, you may actually have a couple of weeks to process that before you start to see the broader markets react. So remember, though, 1 week here, because the data is weekly, it's not high frequency data. So it takes a while for a pattern to show up. So I would look for either one of two things: a change in the Fed's balance sheet numbers. If they continue to go up, the market probably continues to rise. If they plateau, we'll see how long the momentum holds out. If they shrink, I would be considerably worried. The other thing to keep an eye on is the Fed meets at the end of this month, January. If there's commentary about the balance sheet that does not indicate that they intend to increase it further and possibly shrink it a bit, that might be a worrisome sign. I would consider that a worrisome sign. Markets, in theory, should react accordingly, but as I said, there's sometimes a lag. But markets are very sensitive to If the Fed speaks, the markets are much more sensitive to that than when the Fed sort of acts through the numbers. It's a strange phenomenon, but that's the way it goes. So I think that's the big element to be watching for, and I would hope that you do the same.